There's an incredible amount of change happening in the world. That's somewhat a truism, but at the moment for the digital asset ecosystem, which is constantly changing, but the rate of change has really picked up recently. Today, we're going to be talking a lot about stablecoins. So we're going to touch on lots of other topics because I'm joined by Martin Carrica, who is founder and CEO of Mountain Protocol. He's back. And, I hope you enjoyed the episode. I thought it was fascinating. Very knowledgeable person who's close to the changes happening in digital assets. I'm Benjamin Dean. I'm Director of Digital Asset Strategy at Wisdom Tree. Say my name and I appear. And it's so nice to be back with you for Crypto Clarified, the podcast where we help you navigate this sometimes seemingly complex, but actually at its base, relatively understandable digital asset industry, which is rapidly growing once again. It's great to have you here. For US listeners, find wisdomtreeprime.com. It's on the Apple and Android app stores. Subscribe and share the podcast. We put this information together because quality information is extremely important so that folks can navigate the risks and opportunities posed by this new industry. And you can always find me on X, the Bird app, at Benjamin Dean. This time around, and subsequently, the disclaimer will come at the end, so I'm sorry you won't get your favorite part of the episode early on, though it is extremely important. So disclaimer comes at the end, but that means we can jump straight into the interview with Martin. Enjoy. Martin, welcome back to Crypto Clarified.
Thanks, Ben, for having me back. Great to be here.
It's always a pleasure speaking with you and hearing your thoughts about this very fast-moving, evolving space. Since we last spoke, it's been a bit over a year, perhaps. Listeners, if you'd like to get an update on Martin, the work he does at Mountain Protocol as CEO, and our previous discussion, you can find it on your fine purveyor of podcasts. But Martin, in the time that since we spoke last, there's been a lot of changes, especially I know you're based in the United States of America. There's a few ways we could kind of talk or discuss about this. But one of the most interesting ones is around this initiative. I think there's a proposal in front of Congress for a stablecoin bill. But I know you're an expert in this and you follow it very closely. So I look to you to kind of explain what's going on there. We don't have to explain what stablecoins are, but your kind of perspective on, I don't know, the significance or potential consequences of this kind of regulatory change, potential regulatory change.
Yeah. So I think everyone listening to this podcast will know Trump won the election, very pro-crypto candidate. He has several crypto initiatives, particularly the one that I'm the most excited about is giving clarity around how you build crypto products in a regulated manner. And I think the first thing that's most likely going to come through is going to be the stablecoin regulation. There's others, the market structure bill. I think there's other things that people want to see clarified, exchanges, how you do derivatives, etc. A bunch of ETFs. But the stablecoin, I think, is going to be very consequential just because it's like the biggest product market fit in crypto. There's over $200 billion in stablecoins, despite being, I wouldn't say illegal, but like heavily debanked. Many companies didn't want to touch stablecoins historically. So you got to 200 billion despite all of that. I think the stablecoin regulation is going to be a big unlock for the actual usage of stablecoins. And then I can talk a little bit about what I think about this specific bill. I can talk about how I think it's going to impact the market. We are a player in the space regulated outside of the US, so we have our own thoughts there. Let me know where you want to take this.
Let's start with, so to take your point, something grows from, and we had Dan DePiro on the other week, and he kind of said a similar thing. When something goes from 0 to 200 billion in like the course of, let's say, 5 years, it's anomalous. It's interesting. And to your point, in a lot of countries, there was not a regulatory framework in place to in my old OECD days, facilitate the innovation. Now, why would innovation be important? A, to facilitate people doing this kind of activity. They're using distributed databases. And then B, and it's to your point, so a lot of this activity happened outside of the United States of America. So why would it be interesting or useful or potentially a source of opportunity if such a bill, and we don't have to go into the details, the listeners can look it up, it's on the internet. But I know that's kind of a clutch of questions, but what, anyway, your thoughts?
Yeah, why does this matter if stablecoins are used offshore? So first, I agree, stablecoins are a euro-dollar competitor. The reason people use them is the dollar products outside the US, particularly if you're retail. So taking out probably the top 10 companies in each country, they also have access to like relatively solid dollar banking. Everyone else has pretty bad dollar banking. That's retail, that's SMEs looking for payments, obviously crypto traders, which are a big category, etc. So stablecoins found a product market fit there. And just to size the 200 billion, because it looks, I don't know, when you hear in Congress passing bills and like the IRA spending billions of dollars and so on, or $1 trillion, 200 billion sounds small. So to put it into context, that means we tokenized 1% of all US dollars. That is the same as how many electric cars we have in the US as percentage of the total fleet. So it is, if you think electric cars are going to happen, every time you see an electric car in the street, that's equivalent to a tokenized dollar in terms of market share in a way shorter period of time. So it is a huge trend.
But
now,
sorry to interrupt. I do this too much. The difference between electric cars and stablecoins is electric cars, you have to put charging points in, like the equivalent of gas stations for electric cars. And that's quite capital intensive. But if everyone's got cell phones and they can download app and get stablecoin, then adoption rate, ceteris paribus, should be faster, which is perhaps one element. But that is perhaps one answer to my questions before. But anyway,
so you have the capital constraint around electric cars, but on the other hand, electric cars were legal from day one, right? Like you have to, the first car that came out was compliant to run on the road, and you knew kind of like what was happening. With stablecoins, many holders, and particularly many large holders, don't know how to treat a stablecoin in their accounting, right? Like, is this a cash equivalent? Is this an investment? Should I mark to market? Should I not mark to market? There's a bunch of open questions that when you talk to institutions are like, I don't know how to treat this. So therefore, why would I touch it unless I have a massive need, right? So there is that offset to that component.
You're giving me flashbacks of when I taught accounting at Columbia University. FASB and GAAP accounting.
Yeah, there's no strong definition today, right? Like firms like ours, when we do our accounting, you do your best assumptions, right, based on interpreting those rules. But there is no standard on how to account for this. And I think the stablecoin bill is going to be very important around that, right? When you hold stablecoins in your balance sheet, what is this?
Okay.
But to close again, like why I think the stablecoin bill is so important in the US, even though the market is the Eurodollar market, is because it gives clarity, and it gives clarity in the country that sets the tone, right? The US has the most kind of trusted and regulated financial markets. That's why any investor outside the US, they'll invest in their local country, and their second country will always be the US, or maybe they'll start directly in the US.
Okay.
And I don't know, for people in crypto, we say OFAC sanctions, and everyone treats OFAC sanctions as like the rule of the land. It's just the US rule. But the US exports a regulation so strongly that I think, fast forward, call it like 2 years, I think every exchange will say, we'll list US regulated stablecoins. And if you're not a US regulated stablecoin, we'll delist you, regardless of which country they're in, right? Like, I think it's going to have that power of export and that stamp of quality in terms of what it means to be a US regulated stablecoin. And the consumer is going to be offshore, but they're going to be trusting the US capital markets or the US regulation for their asset.
Yeah. Um, we had someone on last year from Vinta, the CEO, and he said the EU, their biggest export is regulations, but it is kind of funny how de facto, because the United States capital markets are so deep and liquid, that those rules do matter. And I mean, this is again back to my OECD days. Folks look to what happens there and then mimic to
Hmm.
some extent. So I can see that. There is a piece here, and I was laughing the other day, not because it's funny, but well, my sense of humor is maybe a bit off. Everybody wants their own stable coin, and we were chatting with Dan the other week about Tether, and it's more profitable than Goldman Sachs and all this kind of stuff. And they're doing a whole thing. Everyone wants their own stable coins. So how do you see? I see fragmentation of liquidity in markets or across markets, right?
Hmm.
How do you perceive that as somebody who kind of daily operates uh, in these markets and also has to think ahead about where the world's going and where opportunity and risk lie?
Yeah. So I would say two buckets of stablecoins that are going to get built. I would say the bucket one is the settlement stablecoins, think like a USDT, a USDC, things that you expect lots of people to use and to transact cross organization. Let's park that because I think that's the interesting bucket to discuss.
Yep.
Then there's the other bucket around like internal ledgers. I'm going to tokenize a deposit in a bank and I'm going to run Signet or something like that inside of a bank with a tokenized asset or inside a company that has multiple subsidiaries, etc., because that simplifies my accounting and so on.
Mm-hmm.
I think on this second bucket, you're going to have thousands of stablecoins because essentially you are creating a tokenized money market fund on the reserve. You're creating a liability on this side, and then you can move that internally in your company. It is more efficient. It is easier to account and audit and so on. So it has some advantages, but it's going to be intra-company. You're
Huh.
going to have thousands of those. On the first one, you have 5,000 banks in the US. And many people think a stablecoin is like a bank deposit, which from a prudential perspective, I agree, right? So when you have a dollar as a stablecoin, you think of it very similar to how you think about a bank deposit. I'm going to be able to redeem this for $1. The difference is when you open a bank account today in the US, you don't care which bank you open the account with because you know you're going to use FedWire to send money to anyone else that you need or ACH or whatever. So
Mm-hmm.
you don't really care if I'm opening an account. I don't care where Ben banks because we're going to have interoperability. I'm going to be able to send you money. If I'm going to choose a stable coin, though, it does really matter because if I have USDT and you don't take USDT for whatever reason, I'm not going to be able to pay you. And then we're going to have to decide where we settle. Do I swap into whatever, some other token that you take? Or will you take the USDT and then kind of swap it out and then take the swap cost and risk out of that transaction? So stable coins, as opposed to banks, have huge network effects because of that acceptability. Many people call it liquidity. I think liquidity is one of the buckets that you need to check. But in general, is if I use the stablecoin, how many people will I be able to transact with? Will I be able to receive it and pay it back to someone else? And I think that's a big difference between kind of like the banking strategy that most people have around stablecoins and the stablecoin strategy per se, which is you don't have a neutral settlement layer like FedWire, at least not today. And there's a conflict of interest where very big players like Tether or like Circle now, they try to avoid you using that neutral settlement layer of FedWire by creating redemption barriers. They will not open accounts to anyone. So if you try to open an account at Circle, unless you're a big company, it's very hard to get it. Tether, same thing. I think you have to pay, I think it's 100,000 to open an account. You have 10 bips redemption fees. So they're trying as much as possible to make sure you don't go back to that neutral settlement layer. So they keep the network effect, and everyone has to keep adding and supporting that the USDC or that USDT. And I think that's the biggest kind of like dynamic difference between the TradFi banking model and the stablecoin model, which is you don't have that FedWire. So building in the space, you have to think, okay, given I don't have that, how do I compete in this space? How do I grow a network? And how do I become one of the handful, let's call it, I don't know, it's probably going to be 10, maybe less than 10, more than 10, but like it's not going to be hundreds, and it's not going to be one stable coins that actually win in this kind of like first bucket, the settlement bucket. So long rant, but I think like that's how you think about them. Like bucket one, there's going to be 10. Bucket two, there's going to be thousands.
What's old is new. So coincidence of wants is the term they use in economics, which is
Exactly.
This is why barter is one of these things it's why actually kind of a fungible currency exists, because coincidence of wants is hard to do.
It's hard, yeah.
At sufficiently large scale. So there's that element, and yes, but that perhaps leads to the next piece, which is, you've said network effects, Metcalfe's law, winner take all dynamics. And one of the interesting things, and it goes back to what you said before, which is the US exporting regulations, because people follow what they do, and that's why it's interesting to see what's happening now. I've got a book somewhere. Listeners, you know about me. I say this every episode.
And your books, yeah.
I have a book somewhere.
For everything.
Birmingham Buttons. Now, I came on a train through Birmingham this morning back to London. And Birmingham Buttons is all about privately issued currencies, because there was a shortage of coins in the United Kingdom at the time. It's around Industrial Revolution. Now, there is kind of a short-term path, and Martin, I'll welcome your thoughts on this, like, because I think it's congruent with what you're saying. If indeed we've got this global distribution mechanism, distributed databases, blockchains, and the laws don't, from jurisdiction to jurisdiction, aren't in line with one another, so no interoperability. That's jurisdictional. That's not technical, right? What happens? Well, you end up with this proliferation of different, call them stable coins. You call them digital euro dollar. Well, most euro dollars are digital anyway, but they run on distributed databases. Like that, and to come back to where we started this discussion, it's already kind of happened, Richard Circle and USDC, but I'll be interested to see if there's like General Electric USD, which is, if you want to work with General Electric, and I'm not picking on them, I'm just saying like that's a gigantic conglomerate, or it could be ByteDance, and they issue it via TikTok, right? That whole thing is going to play out, and we'll find out if Metcalfe's law, what it can like obsolete, but we're about to see like the Birmingham Buttons experiment again play out, just on databases and on a global scale.
And I think it's going to be very interesting because we do have an example of how this experiment was run and was not solved, which is the correspondent banking system. And that's why SWIFT payments and SWIFT settlements are so complex, right? Like every stablecoins to me look more like a correspondent banking deposit than like a US banking deposit, because like you have something that you're trying to settle across multiple parties when you choose a single correspondent bank. But when you have different correspondent banks, you have to find a way to route between each other, and you still don't have like that system is not fully oiled, and no one has solved that problem, right? Like you have some bigger correspondent banks, but like not every, like there's hundreds of correspondent banks, and if you send a wire, particularly between one emerging country and another, you're going to see a route that goes through 5 banks in the end to try to route that payment. So you kind of already have that, and that's why essentially stablecoins go from those 5 to a single correspondent bank, which is called Circle or called Tether, and you just like do an internal ledger transfer between these two. I would say the other thing that's interesting and that I'm watching is in the Haggerty bill, there's a section dedicated in the bill around interoperability standards. It's kind of quite broad, but it acknowledges this problem, right? So I think people in Congress understand that this is an issue, and that this issue, they want at least dedicate resources to investigate this issue. In my opinion, the solution should be, you should be able to redeem kind of like maximum T+1 versus Fedwire without any fees. And I think that is a reasonable request from issuers that want to conform to this, that gives them operational, like it's not T+0, right? So it's not same day. You give them some time from an operational perspective, but you make it no fees to redeem, and kind of like T+1 in a neutral payment system, which is Fedwire. I think that is a good proxy for a solution, if I could suggest one. The other thing that you touched upon, which I think is very interesting, is the TikTok USD. I think my biggest candidate of like a stablecoin issuer that is not consensus is X. X has been collecting money transmitter licenses like crazy. I think they have tens of them. I don't know if it's like 30 or 40. I lost count now. But it's like such a good place to issue a stablecoin and then kind of like serve the world, right? And I know Telegram tried this, but Telegram didn't have ramps.
Facebook did as well.
Facebook did, and it got blocked, but it was a very good effort.
No, twice.
Yeah, but and they tried it in India without telling the regulator, and they got slapped. Yeah, but I think X could be a very interesting one, because if they do it as a regulated US stablecoin with ramps, it could be a very interesting like global Venmo challenger or something like that. So I think that's one I'm watching. Bank of America, obviously, their CEO recently said they're going to issue one. That was my non-consensus before he said that.
Okay.
Obviously, they have 120 million accounts opened already. So it's like the biggest on and off ramp network that you're going to see for stablecoins. So I think it's going to get very, very interesting. I think like those are some of the. So you have obviously USDT and USDC have cemented kind of like some lead. So it's like, okay, who are going to be the post kind of like bill winners that are going to win in category one? And I think obviously like Bank of America, JP Morgan, like the GSIBs are very good candidates. But I could see an X.com getting there, or someone like that. I think X is a very good candidate. Facebook maybe, but I don't know if they're like too burnt.
They didn't do AI stuff supposedly.
Yeah, so I think it's interesting to think like who are those going to be. I think the critical part is going to be who has a relationship with the end user that they can expose, and who can provide good on and off ramps to serve whoever needs that today, right? And like I don't think Citi can do that, because Citi banks higher net worth people mostly in the US, and I don't think those people need stablecoins anytime soon. Whereas Bank of America, tourists come to the US to open Bank of America accounts. So there's a huge euro-dollar market served by Bank of America. So I think about like that dynamic on like who can get traction quickly as a way of who's going to win.
All right, let's see if I can express this coherently. Listeners, it's technology history time. And as everyone knows, nobody loves technology history more than Benjamin C. Dean, right? So I think the listeners will remember this one, that Western Union started as a telegram company. And putting down the telegraph network was extremely capital intensive. The same way putting down broadband fiber optic networks was capital intensive. And so that meant that one had to be able to make sufficient amount of revenue, profit, subtract costs over time. So that means fees for using network higher in order to generate profit over the lifetime of the infrastructure. Now, second piece, economics history. In a market with perfect competition, or at least, perfect information, but it's really about a competitive market, profits are competed to zero.
And there's switching costs. So,
and transaction costs and lock-in, and yeah. So what's happening in one way here is that and it goes to your point, right? Like, why wouldn't certain large American banks do it? Clayton Christensen innovator's dilemma, because it's not profitable to serve a certain portion of the market that's underserved. A. B, why don't they do it? Well, because the operational and organizational structure are too much overhead, so they can't make a profit, so they don't serve the market there. But what have we got now on distributed databases, which are open source, accessible from a cell phone anywhere? Most people have got either a smartphone or a feature phone, and they're internet connected anywhere in the world, right? Suddenly the competitive landscape looks totally different. And I think we're seeing this, and it comes back to where we started, which is, we need a stablecoin bill. Well, why do you need a stablecoin bill if people are already using it, right? And it's growing. And so I guess we'll see as competitive moats are established around regulatory acceptance, which is fine, because we want things to be done in a transparent and accountable, correct way. But when Martin, I don't know if you know how much time I spend in Turkey. I was there again last month. And people will accept USDT on cell phones, straight from my cell phone to other cell phone. Of course, it operates over open source software, distributed database, public key cryptography, so on. But that already is happening. So it's it's like, who is going to find a way to capture that market? Because 200 billion is not zero. But it's not like the turnover in T-bills, US T-bills, we could say, but it really doesn't matter. You could use T-bills from many different countries of a sufficient size. All that's changing. But it's entries on distributed databases, right? The marginal cost of putting entry on database is close to zero. It's a little
that
like when
cost is going to go to zero. But the entries in the database reflect something, right? So when you go to your city council or whoever it is, and they have a registry that you own this piece of land, the registering that is very cheap, but the piece of land it represents is very valuable, right? So I think the representation is what does that new database hold? The asset it holds is still that's where the value is, right? We moved from paper to a server, to the cloud, to on-chain. It's still the same asset, right? It's still the same deed or the same dollar that you're moving to different databases. Now, I think the interesting things is why would Bank of America care about this? And I think distributed databases change the economics profile significantly. You talked about you paying someone in Turkey cell phone to cell phone. That is enabled by many things, but I think the biggest thing is the cost of compliance goes down dramatically because you go from PDFs and manual wire room verifications to AI and chain analytics because the data is public, right? So the cost of compliance goes down dramatically, right? Tether has, I don't know, let's ballpark 100 or 200 primary customers, and they have hundreds of millions of secondary customers. The cost of serving each of those is negligible, right? Versus the cost of opening an account and keeping that account open for someone is very, very high. So I think that's one. And the other one is we created, depending on the blockchain, but let's just say Ethereum ERC20 standard. So integrating these things is very, very cheap because the standard is a global standard with standard and open APIs that are permissionless to use. That is equivalent to how many countries have talked about open banking, and you're doing open banking inside of that country, and most of these open banking projects have not been shipped. This is the equivalent of a network that has open banking built in, right? So you have lower cost of compliance, significant lower cost of compliance, and in my opinion, better. If you look at laundering of funds, very, very hard to launder funds. Most tax never are able to launder the funds. I would say with some exceptions dealing with Bitcoin, we recently saw the Bybit hack, particularly in China, but very hard to launder funds unless you're a state actor, right? So very, very hard to do. And still doable in fiat. Most of the money laundering still happens in the banking system, which is what, there's always going to be some laundering, but the question is risk-based. Where is the issue? Crypto is very, very safe, and most people will not get their money into crypto because it's easy to launder. And then the second is way easier to kind of build stuff. So I think when you look at why did the CEO of Bank of America mention 2 weeks back that they wanted to launch a stablecoin whenever the regulation is there? Is the margin cost to serve a customer goes from, call it $10 a year for a retail customer to like practically zero. I'm opening from serving the US market to serving the global market. The euro dollar market is only 10 trillion. So it has an 8% penetration on the global M2, but removing the US. How many people would dollarize if they could? And the constraints on dollarization have happened because the infrastructure is not good, but also because governments could constrain it because it happened through 6 banks in a country. It's easy to put 6 people in jail. It's very hard to control 100, like a P2P market with like 100,000 people inside of a country. So like how big can that market be? And then third, like what's the business model?
Especially if you grow the market, like it's not.
Yeah, exactly. So I think the euro dollar market is going to grow from 10 to probably 20, 30 and trillion. And then you're going to have cannibalization of that 10 going from like Web2 infrastructure to crypto. So the addressable market is several trillion, probably tens of trillions. And then the other piece is like the business model. Most people think banks make money by lending, but if you really look at banks today, after all the crises, each crisis you have is one less lending opportunity that the regulators allow banks to take. So essentially, the risk that banks are able to take has gone down each crisis. And if you look at the lending rates today from banks, like they're almost lending at SOFR. If they can lend a little bit higher than SOFR, they consider themselves lucky. They're doing AAA corporates, they're doing mortgage-backed securities, and maybe they're doing like some CRE, but usually that's smaller banks. Essentially, banks are in the business of getting the spread between paying zero in deposits or paying very low in deposits and lending at some margin over SOFR. So if you're lending to the US government at SOFR, you're not giving too much on revenue. And if you can do that at a very low cost of deposit, particularly zero on USDT and USDC, that's a massive chunk of money. The average NIM, net interest margin of a bank, is around like 2.5. Tether's is like 4.5, right? So it is a massive opportunity in terms of the scale of like the deposit base and in terms of the profitability of that deposit base. So I think many banks are gonna flock to this, and depending on like the merits and how they execute, the big question is execution. Right? Like we all know these big institutions, they have a very hard time getting like not shooting themselves on the foot to actually ship a product. But I think all of them should try and see how they can win a piece of this market, because I think it's the biggest opportunity from a growth perspective in the last couple of decades. Like it's a huge new market for US institutions.
I mentioned growing the pie. Like if one steps back and looks at it, it's like how many financial or like just economic transactions, interactions between people don't happen purely because it's prohibitive due to expense, or it's just not, it's prohibited because it just can't be done, right? Which is sending information. More economic activity, as long as it's not criminal activity, good. That piece. We could talk about philosophy, theory of money, and things like that if we want. But your point earlier, and sorry, I'm going to do a grab bag of points here, and then we'll close the episode out because we're coming up on time. Standards you mentioned. Well, I live in London, and Greenwich is well, I know where Greenwich is Greenwich median time. And why was Greenwich median time set? Well, because British shipping and the French government at the time, I don't know if it was a monarchy or not, but they kind of debated on where that point should be set. The British won. But that's why it's GMT, right? And that standard sets the means by which folks can do economic interactions with one another. And it's still there today, right? So standards important. And I'm not going to tell the story about me going to the National Institute of Standards and Technology in just outside of Washington, D.C. to talk about encryption standards. Listeners, don't worry. I'll tell you about that another day. The second, to like, and I'm kind of riffing off what you said. There is a piece around like the data being written to databases, but there's another kind of more essential point. It's it's actually required to facilitate this kind of activity. Some people call Bitcoin the time chain, and it's because the entries on the distributed database are time-stamped and immutable. It's there. Like you can point, it cannot be changed, which is different to land titles done through other means, let's say more paper-based or PDF-based, where someone can go and say, to your point, oh, well, you've got this valuable asset, but whoops, got burned in a fire. I guess you can't prove it, right? With the time chains or the distributed databases using public key cryptography, anyone can go back and point at and say, oh, no, I own valuable asset. And by the way, I have the keys to use it. They're very big changes. Anyway, I'm bouncing off your thoughts and we could go on all day, but I know we're coming up on time. As you know, from the last time you were with us, we finished the episodes thinking about the future. And I could tell you what I see at the moment, but I'm more interested in, and I think listeners will be more interested in what you're thinking about. Open-ended question. What if you got your eye on what you think's interesting? Doesn't have to be crypto or digital asset related. It could be anything, but you know, you've got your eye on a lot of things, I'm sure. So I kind of open it to you on what you think.
Yeah. So crypto, obviously, I think stablecoins are next, and I think it's going to be tokenized assets. We saw Vlad from Robinhood talk about that. We saw Brian think about tokenized coin. So in crypto, I think it's inevitable. 10 to 15 years from now, everything is going to be in a blockchain. The question is like how we meander to that point. Outside of crypto, the piece that I'm looking at is robotics and humanoid robots. I am very curious, and I follow it on the side. I'm not an expert. I'm not a mechanical electronic engineer or anything like that. But I just think from a societal perspective, it is amazing to think you can now have something that does work, even if it's like not at the level of a human, even if it's at 50% of the speed or quality of a human, that can essentially replace a lot of manual labor that we're doing today, and how that impacts the market. And like there are several questions that I like to think about. Like first is, you don't even require AI for robotics. Like you could offshore the robotic management and have someone driving the robot from a lower cost jurisdiction. So you can convert $20 an hour to like probably $5 an hour and get 75. Sorry?
Mechanical Turk is the same concept.
It's like a physical mechanical Turk. Exactly. So you convert that labor. And I think the big impact is going to be the robot, not the AI. I think the AI is the last 20%, and we're going to discover a lot of new use cases with that. But just the robot itself is going to be fantastic. And you see these robots are getting good very, very quickly. Yeah. I would say that the second question is, how does that impact some sort of skilled labor? If you think about a licensed plumber or a licensed electrician, if you can have an electrician from some other country go and hop on the robot and drive that robot and do that electricity work, right? Particularly in something that can potentially be risky, the robot is taking a lot less risk. So how do we do with the regulations around that? I think that's very interesting, and opportunities around building like expert marketplaces for these robots. And I think that the other one is, when are we going to start preferring a robot versus a human as a nanny, for example, or as like a senior caretaker for seniors? Because if you think about a nanny, you're bringing someone you don't know into your house, unsupervised. Maybe you put a nanny cam, right? Like that's as much as you can do.
What people do.
Versus a robot that is monitored by AI, and whenever there's something suspicious, you can go to a second level person, and everything is recorded. Like, when is it going to be safer to have a robot than have a human? I think probably not that far. And the last question is, what happens with the opposite? What happens when someone in some random country goes crazy and like commits a crime using a robot?
Someone hacks
it. Well, hacking, of course, but I think like just, let's say this robot is in someone's home and that person, I don't know, is doing something weird and the robot decides to kill someone, right? The driver of the robot, he executes the crime through the robot, like grabbing a knife and stabbing someone. So I think there's a lot of questions around these humanoid robots that like we're not thinking a lot about, but I'm very, very optimistic on like how things can be changed. But there's also going to be some bumps along the way, right? Like same as self-driving, right? We have
exactly.
accidents in self-driving.
Exactly.
It is an amazing
Okay.
technology, but there's bumps. And if we don't talk about the bumps, we're not going to get through them. So it's like that is going to happen, right? Like the robots are not going to be fully AI day one. So that's a piece that I'm very curious about. I follow a bunch of the builders, particularly I think Figure and Tesla are the two big ones, and then some players from China. But that's something I'm looking at. I'm like, I want to get one for my grandma, right? Like to take care of her. I want to get one at my place. So I don't know. I am. It is something that like sparks my imagination and kind of like the engineering me like very, very nicely.
Yeah. Well, you got to stick with your Roomba for the moment, but yeah, I also monitor, and Figure is very interesting. The one that you've reminded me of to close this out is, and the listeners might remember this from the conversation with Dan. Boom is a company that does supersonic aviation, and this comes back to where we started. So I'm not just like throwing ideas out. I'm bringing the episode to a close on where we started. Boom is trying to get their supersonic jets that they've designed through regulatory approval in the United States, because the regulations are set up for speed, not sound when they break. I think it's Mach 3. Is that right?
What I followed on Boom is like they go at a certain speed where the sound cancels each other, so you don't generate the sound in the bottom.
Yeah, they come up with a way to
exactly, which is amazing that like these things happen, you know.
Someone's got to do the work.
Yeah, but like a lot of like one of the things I'm excited about is in Argentina we have this ministry called Ministry of Deregulation, and this guy Federico Sturzenegger. It's not Doge. Doge, I think, has been focused on cost cutting, which I think is a good thing to start. But at some point, we need to pivot into like, how do we create a system where you can propose something that doesn't make any sense, and we can change those regulations. And I think the example you gave is like, we used speed as a proxy for sound, but the problem is actually sound, not speed. So how do we adjust that regulation? Like everyone I'm not able to Steelman it, but like, if there's no Steelman for that, like it's an obvious change, right? Like one of the changes they did in Argentina recently was if you had a gas pump, right, like where you put gas on your car, you were required to put the gas tank under the level of where the cars are. And lots of people were complaining because it's very expensive to do that. And they were like, we drive gas pumps, like gas tanks, on the road in a gas truck. So it's good enough for the truck to be on the road, which is a lot more dangerous, but it's not good enough for the pump. So like, why don't we like just use the same standard? I was like, yeah, obviously it makes a lot of sense. So they just changed the regulation, but now they've built this muscle around like removing like unreasonable stuff. And I hope the US gets into the same piece. And my wife is doing this master in real estate. And there was this case, which was a developer in the 30s bought a piece of land near a lake, and he wanted to use it for industrial purposes. And the city told them no, and that case got to the Supreme Court, and that's how zoning laws became to happen. And they said, okay, you own your piece of land, but the city can restrict what you can do in that land. And the guy like essentially lost a bunch of money because it had to be used for residential, not for that, so he didn't develop it. 10 years later, the U.S. government buys a piece of land and puts a factory for like, I think airplane engines or something like that. And the story is like the federal government can supersede what the city or the state says. So there's a lot of power in Dodge to remove these regulations, even though they are stuck in a city level or in a state level. In the end, the federal government can remove a lot of that red tape. So I'm very bullish on like past the cost-cutting stage of Dodge once we get into the deregulation state of Dodge and can unleash kind of innovation. So very, very bullish on what they're doing. And I think if we don't destroy ourselves by playing politics, I think we can get into a very good place with Dodge.
When you come back, we're going to have to take that last one and really unpack it and then relate it back to kind of, we could talk about stablecoins or yield-bearing tokens which I know Mountain works on. The answer back when I worked at OECD was sunsetting clauses, which is after a certain amount of time, the thing needs to be rewritten. And that kind of, well, you can't get the cadence quite right, in the sense not perfect. You rewrite the regulations over time as the world changes and as you learn new information, especially from other people's experiments in different places. Anyway, Martin,
Great to chat. We could be here for hours.
Yeah, we could do this for hours. So you have to come back soon if you've got time. And we can talk about how the Howey test comes from like an orange farm and like stuff like that.
And other tests. I hope we see something around that soon. I think the SEC has been very active and continuing to provide guidance there. I think we over-index on the Howey test a lot. I'm not a lawyer, not legal advice, but I do hope we see some of that happening soon.
Yeah, well, next time we speak, we'll do kind of an update on it and
Awesome.
see where things go. But it is a very interesting time. I know from where you sit with Mountain Protocol, you have your eye on a lot of different things that are happening. So I really thank you for taking the time to chat with me today. And also, I hope the listeners enjoyed the episode because, as we said, we could go for hours and hours and hours, but there's only so many hours in one day, 24. So there you go. We could talk about standards in 24 hours.
Ben, thank you so much for having me, and let's do this in a couple of months.
That sounds great. It'll be great to have you back. Thank you, Martin.
Take care.
There you have it, folks. Martin Carrica, founder and CEO of Mountain Protocol. I hope you enjoyed the episode. Now, I know you've been waiting for the disclaimer because it's extremely important. So, I need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and Mountain Protocol. They're also subject to change. Anything we presented in this podcast is not intended to be relied upon to forecast research nor as investment tax advice. The information and opinions expressed in the podcast are not a recommendation, offer, a solicitation to buy or sell any securities, and reliance upon them as a sole discretion listener. Please remember, past performance is no indication of future results. Thank you again for joining us today. I hope you enjoyed it. And, well, as long as this space keeps growing and changing and the world keeps, you'll be back, I hope. So subscribe and share. Come find me on the Bird app, X at Benjamin Dean, and I look forward to having you back again in the very near future.